All right, so let's get going. So appreciate everybody being here. So what we're going to talk about here tonight is some really great low risk, high reward type option strategies to use. Now, these are two strategies that I use a lot at Power Cycle Trading. Excuse me, the butterfly and long condor, and they're really unique because I mean they're great for any type of market environment, but especially when we get into higher uncertainty type markets, higher volatility type markets where you really want to get the risk under control and low, as you're going to see here. So that's what's really great about these strategies. We can really control the risk. We can really lower our risk, but we can also maintain potential for very large returns on that lower capital risk. And the theta, positive theta, is a huge benefit as well from these types of strategies. So let's get going. So the following presentation here is purely for educational purposes. Any stocks, options, futures, or ETFs mentioned does not constitute advice and should not be construed as a recommendation. So to me, the secret to trading profits come down to three basic things: direction, timing, and then options for your risk management, or for what I call opportunistic kind of risk management. And the reason for that is we can do so many great things from a hedging standpoint using certain option strategies, and we're going to talk about that quite a bit here tonight. Now, option trading has so many more advantages than just outright trading stocks, but as you probably all know here, that it can be a bit more complicated. But once you understand the benefits and the advantages of using option, and especially option spreads, you're never going to really look back. So when you're using these spreads correctly, it's going to provide you really defined trading risk. It's going to lower your capital at risk, provides greater trading leverage, and an unmatched hedging advantage for your trading. Now, I've been trading options for over 30 years, and I've found that the most valuable go-to option strategies that can help literally any trader more than any other strategies out there, and especially when we get into uncertain market times, are to incorporate using the option butterfly and long condor into your trading. So it's kind of what I call my secret trading weapon. Now, the huge advantage that you get from these two types of strategies is that they can be designed to take advantage of time decay and volatility. And so those are the two main option pricing components, for options. So we can use this to really help stack the trading odds in our favor. And these can be used for any type of trading environment, which makes them a really strong favorite when we get into more uncertain times or really extreme market volatility. So it all comes down to just knowing when and how to use these strategies. So because they're structured to require only a small amount of your hard-earned capital, your trading returns can be very explosive. So a lot of times I kind of call these trades lightning in a bottle. So I'll show you some really good trade examples here tonight to illustrate that. Now, when we look at the butterflies and long condors, they're very dynamic, and they can be traded for a variety of different reasons with different goals in mind. So in other words, you learn how to trade the butterfly and the condor, and you're going to be covered for both your offense and your defense. So your goals and your protection for what you want to accomplish in your trading. Now, these types of option spread strategies can work no matter what the market cycle is. So it could be a trending up, down, or sideways. They can provide income from stocks that are going nowhere, eliminates the stress of having to be perfect on a stock's direction or overall market direction, really helps to eliminate the time decay expense that you're going to encounter from decaying long options, takes the unsettling guesswork out of your trading, can really be structured for low cost, low capital at risk, and you'll see potential returns of 10 to 1 or higher based on this low capital. So you get tremendous reward to risk kind of benefits from these strategies. Now, the butterflies and long condors are very flexible. So as you're going to see ahead, I'm going to show you a lot of different trade examples here in a few minutes. And once you learn the fundamental then setup of how to use these spreads and these types of strategies, you can really help this in your trading plan to give yourself both your accomplish your trading goals or profits and your potential insights as to a market direction up or down. But you can also use it kind of a more delta neutral where you don't have to be very specific exactly on that direction. But to me, the real beauty is that they can be incorporated and used for directional trading, offering you either bullish or bearish exposure to the market or stock that you're looking to trade when you feel very confident about maybe where that specific stock's headed one way or the other. But the thing that makes these types of strategies so great is that if you're wrong, the butterfly and long condor helps you to manage and keep that risk low, but at the same time retain the potential for a large return on your risk. Now, let's be real though, these types of spreads are not going to give you that unlimited potential profit like if you're just buying long calls out of the money, but they're usually going to cost you a lot less than buying outrights, and they'll offer you an amazing risk reward trade setup. So this means that the butterflies and long condors can significantly increase the probability of your winning trades while also reducing your risk. And in trading, that's really what it's all about. Now, when we look at the butterfly and long condor, they can be used to hedge, okay? So when you mess a trade up, this is a really great, fast, low-cost way to cover your you-know-what pronto when a position you have starts to move against you. And I've literally found no other hedging strategy that comes close to using the butterfly or condor hedge. Now, by constructing either a butterfly or a long condor around a strike or that's under pressure from another core trade, such, let's say you have a credit spread on, and the price of the credit spread starts going towards your short strike, and then it goes through your short strike, and now you're potentially at risk for the whole amount of capital that you put up, or the other side of a debit spread. So you put a debit spread, starts going against you. The condor or the butterfly hedge on these types of spreads can really quickly reduce your risk, but also then structure it to where you still have potential for a large return or leg in or out. So these types of strategies are fantastic for hedging. I'll go through and show you some examples, but this from one of my members. She used to do a lot of credit spreads, and she said, I wish I'd known how to do this hedging before I lost so much money doing credit spreads. So this is probably the go-to strategy for hedging a credit spread that starts to go against you. So we'll talk about that quite a bit as well. Now, when you're looking at this for hedging, what we're looking to do with this type of hedging strategy is basically you can keep the original position open by just implementing either a butterfly or long condor hedge on your original position. So a lot of times, you'll see that you get a trade, you're putting it on, it looks great, and then all of a sudden a news headline comes out and it reverses the momentum the other way, but then you maybe stop out and all of a sudden it comes back. So it's going to happen to us as traders, and it's really aggravating what that does. But when you do this type of hedging strategy, what it does, it's taking advantage of time decay. So when we incorporate maybe putting a butterfly or long condor on a core trade, we can then sit back and wait, see if the market settles or that trade settles and then continues on. But we're going to get paid from that time decay component while we're waiting it out. So a lot of times you just need that little bit more time for that original position to stabilize, move back in your favor, and then you can remove the hedge and just ride it out. Or you can leave it on and just kind of keep it as the butterfly or condor. Now, the basics of the trade is pretty simple. So here's an illustration or example. So here would be like a call debit spread. So you could do this with puts or calls, but let's say you're long a call here, short a call, so that's a call debit spread. Now, your risk on the debit spread would be $300, so that's the maximum risk. But if it starts to go against you, the maximum you lose 300. But what I like to do is never look to lose that full amount of risk. So we could adjust this quickly by either converting it to a butterfly or a long condor. All right, so let's see how that would work. And it doesn't take, it's pretty easy and simple to do, and it's a quick way to neutralize the position. So all we could have to do is we could sell a credit spread against it. So we could sell this credit spread with the same short strike as your debit spread. And in this example, bring in 200. So we sell a call here, buy a call. Now we've got a call credit spread. We brought in $200 credit, and we just converted or adjusted this trade to a long call butterfly. Or, we could do it the other way around with puts. So we took that $300 of risk on the debit spread side here, added the credit spread, brought in $200. Now we've got a total adjusted risk of just $300. And we've got the option to just stay with the trade as it is with the butterfly. And if it goes out anywhere in this profit zone, we can make a really nice return on lowered risk, or we could leg out. We could close out the debit spread side or the credit spread, or we could even add additional credit spreads to it to create like what we call ratio butterflies to bring in more credit to the defense of your trade. So it gives you a lot of flexibility and options for adjusting your trades. Now the long condor is similar to the butterfly, but the thing that is great about this one is we can separate and spread out the short strike to give us more potential or bigger profit zone. So basically we're long, either calls or puts. We're long that call debit spread. With the butterfly, you've got kind of a narrower window or profit zone, but this, you're spreading that zone out, so you've got a bigger zone for profit. So this is usually the first go-to hedge. I'll set up the long condor first, and then if the market still looks wobbly or might not recover, I could close out this short call credit spread here or put credit spread and revert it or adjust it down to the butterfly. So a lot of different things that you can do once you just understand the concept of these vertical spreads and how they react. So the core concept that really makes the butterfly long and long condor dynamic is the pricing structure. Now, the most important option factor for profit generation using these types of strategies really comes down to understanding how option pricing works and the concept of time decay or theta and the effect that it has on the price of your option. So let's take a look at how that works. Now, when we look at the theta, which is kind of the time decay component of your option price, it tells us how much your option price will go down over time. So that's the rate of the time decay of your stock or whatever security. So this time decay occurs because of that extrinsic value, or what we call that time value, is going down each and every day. And as you get closer and closer, it accelerates as you get closer to expiration. And at expiration, it goes to zero. So this is what we're taking advantage of when we do a butterfly or condor. This is the sell side component, which is selling time and volatility, so we can take advantage of that time decay. So let's take a look at some examples of using butterflies and long condors. So first off, let's say we had a company XYZ and it's trading at $45. And directionally, we're looking for it to go down. So in this example, just to $43 is our price target. So before you ever put a trade on, I always look and put together price targets. So what's my target, price for profit taker? What's my target price for defending a trade or stopping out? So in this example, we're just looking for a small move to 43. And the great thing with the butterflies, they're kind of more short duration trades to take advantage of that time decay. So we can set these up, for 1 day to 1 or 2 weeks out. And it also, we can make really great returns, and we don't have to have a huge move. So in this example, you would be long, we're looking for a target of 43. So you're long the June 44 put, and that costs you $2.38, or that'd be $238 for one option contract. Now, then we would sell the 43 put against it, bring in $1.67, and then sell another 43, bring in another $1.67, and then buy below that the 42 put. So we have capped risk. So what we've just done is we've just constructed a narrow wing balanced butterfly. Okay, so we're long the 44 put, so this would be long the put, short the put here, and then we sold another bull put credit spread, same short strike, and bought a put there. So if you add everything up and do the math, you can see that you've got a debit cost of $2.38 and $1.06 minus the credit you received from selling the 243 puts times 100 just to convert to the option spread. One option contract is equivalent to 100 shares. So you can see your maximum risk here would be $10 per butterfly. So that's the most you could lose. Now, you can see your profit is then you just take the spread width, 44 minus 43, so $1, or 43 minus 42. You can see there's $1 between the strikes, so we call that the spread width, and that would be like $100 wide spread. So you take that less the cost of the trade, in this example, $10, and you've just backed into what your potential profit would be. So 43 minus 42 minus your cost of the trade, 10 cents, gives you the potential to make 90 cents, which is $90 per spread. So if you did one option butterfly spread here, your max risk is your debit cost of 10, and the difference in the spread width of $100 minus 10 gives you the potential to make the difference of 90, which would be a 900% return. Now, you'll never make that exactly on a butterfly because, you know, it's threading that needle, but you can come close. But the big takeaway is that, you know, you can see that you're basically risk $1 to make 9, but even if you made, you know, $5, 5 to 1 or 2 to 1 or 3 to 1, that's still a huge return on your risk. And that's what we can do with these strategies. We can really lower our risk. So let's look at some of the different butterflies in the long condor and then go from there. Now, in my opinion, one of the major goals of every trader really should be to look to select trades that are going to, you know, provide you the most consistent positive returns with low defined risk, and not always, you know, the big hit home run. So to me, it's just you want to chip away, you know, singles, doubles, and then you're going to hit, you know, the home run occasionally. But if in trading, you want to stick with the game that gives you kind of more consistent profits, and that's what these can do on very controlled low risk. So you want to then look to see, okay, what are the different option strategies out there that are available to you, then understand how they work, and then what you want to do is select the one that's best suited for your trading goals and the market environment you're trading in. So everybody here tonight, you know, is going to have a different amount of trading capital. So Charlie might have 10,000 or 5,000 capital to use, but Susan might have an account of 100,000 or a million, whatever. So it really doesn't matter. But what you want to do is, what I look to do is control my risk. I look at the risk first, and then I look at the potential return that I can make on that risk. So I started out that way and look at risk first always, and then the return. And then that way I can do my risk reward to see, you know, if that trade is worth doing. Now, when we look at the different variations of butterflies, there are a bunch of different kind of structures. And so it's what I call the butterfly family. So you could do a long call or put butterfly. You can do what we call the broken wing butterfly using calls or puts. Sometimes you'll hear this referred to as a skip strike butterfly. You can use the ninja butterfly, which is an unbalanced or ratio butterfly. There's the iron butterfly, and then there's a whole nother category of hedging, so defending trades using butterflies. And then we have kind of the cousin, the long condor option spread that's very similar. So the thing that these have in common is they both have a sell side component of the spread where you're selling time and selling volatility. And then you have a long side component that gives you the bigger potential return from it. So it's a combination of two different vertical spreads, a vertical debit spread and a vertical credit spread. So it gives you the kind of really good benefits from both. Yeah, so to close out a butterfly or condor, you know, it is two different spreads. So you could put it on as one whole spread, or you can take it off as two separate spreads, or you can leg into it that way. So they're great from that standpoint because we can leg in and out of the trade. So if you were to, let's say you did a call debit spread, I'll just kind of illustrate this. So let's say you started out and you're bullish and maybe you started out long a call. So here's how you could do it. So you might be long a call, and then you want to reduce the risk of your long call. So what we would do is sell a call against it, and that creates a call debit spread. Now, if we wanted to reduce this risk even more, we could leg into it and we could sell either another short call here with the same short strike, buy a call here. So that just adjusted it to a butterfly, or we could, if there's enough premium, we could spread the spread width out here and make it the condor. So we can do this with calls or puts because we're just combining vertical spreads. So what I call kind of mixing and matching. So it gives you a lot of flexibility. So it makes it a really dynamic structure. So let's take a look at a bunch of different trade examples so you can get an idea of how these work. So here's a butterfly. Okay, so the other thing I wanted to point out is that when you do a butterfly, you know, it's called a butterfly because the body of the butterfly is the short strikes, and then the wings are the long strike. So we can control and adjust the risk and a profit of a butterfly by the wingspan. So think about it. If you were a bird collector or butterfly collector, and you're going to be able to catch a butterfly easier if you have a big wide net, right? Versus trying to do it with a small net. So we can adjust the risk and the profit potential of a butterfly by the wingspan. So we can make a narrow wing butterfly, which would be very low risk, but we're going to have less profit, but the return on our lowered risk is going to be huge. Or if we wanted to get a big profit zone to really get a bigger zone of potential profit, we can widen out the wings. Okay, so we're going to go through a bunch of different examples to kind of illustrate how that works. So the first one I'll start with, I'll show you a narrow wing butterfly. So this is going to be a butterfly with the spread width of $1 between the spreads, which would be $100. All right, so here butterflies are also great for the ETFs, SPY, QQQ, IWM, gold, GLD, things like that. Really great to do butterflies, or the index options like SPX or INDX. Now in this example, this is a really narrow wing, low risk trade using the SPY. And I always set out targets first. You always want to have a target, profit target, and then you can construct your trade and see what the risk to reward would be on that trade based on your target that you're trying to achieve. So I use Fibonacci levels and moving averages. So from this example, there's a swing high to low here, and it gave us a target here based on Fibonacci at about 273, 274. And there was also good option activity here, from a lot of option buying. So that gives you a good strong target. So we wanted to do this trade with a very low defined risk. So first off, we're going to target this 273 area here, 274. So to do that, we'll set our butterfly up, and the short strike, or the body, which is the short part of the trade, will be the target that we're looking to achieve. So if you look here, the target of this trade, we're targeting 273 to the upside. So it was traded at 267. We thought there's a really good high probability to go to 273 based on the Fibonacci levels, that option activity that was there. And so we did a kind of a short duration trade here, set it up on the 14th, and then it was going to just be into the expiration on Friday, 2 days later. So bought the 272 call long, sold the 273. So you can see it's a dollar wide spread, and then sold the 273.74. So if you break that down, you've got a call debit spread, and then you've got a bull put credit spread, and that created your butterfly. And it's a narrow wing, so it's very narrow. The spread is $1 spread width, so that'd be $100. And then the cost of this trade, you can see here, 10 cents or $10. So that's the maximum. If everything went wrong, it went straight down, straight up, the max you'd lose would be $10. Now, but if it went and hit the body into expiration, 273, theoretically, you'd make 90. Now, you're never going to make that exact, but you can come close. And that's 900% return. Now, the only thing that you need to be aware of, if you're doing a butterfly, you do have a short vertical credit spread on that. So the only thing that you always need to be aware going into a close, make sure that if you have the short strike of your spread, make sure the market at expiration is not at that short strike, or that it's not in the money. So in this example, the only additional risk you would have here is if it was trading right there at expiration at 273 or 273.05, something like that, then you want to make sure, double sure, that you closed out the bear call credit spread, the 273, 274. Otherwise, if it had gone down to the downside, you don't have to do anything. All the legs will just expire worthless. But we'll talk about that more. But that's the only thing. So it's a very simplistic type of trade once you break it down. Now, in this example, though, the trade went out with $70 per spread profit, and that's huge, right? That's a 700% return on your risk of 10. So that's where you can get the potential huge returns on these types of trades. So sometimes we can call these a lotto trade, because you can put up so low capital and get such a high return. Now, this trade was going out at expiration on the 16th. it was trading right there at 273. So almost perfect, but not quite. That little black area there is still what's left of time and volatility in that spread, but it's still a pretty good, outcome. So you can see that it was trading right here about 273.08, and right before the close, that you can see that this went from 10 cents and now it was trading at 80 cents. So there's your profit of $70 per spread on that risk of 10. There's your 700% return. So in this one, the example of 4 contracts, that was a profit of over $280 with your max risk of $10 per spread, or in this case would be $40 would be your maximum risk. So that's what you can do by controlling the wingspan of the trade, and that's why you get such huge returns. So a lot of people might say, you told them, hey, I just made 700% return. They might think that you're making it up, but these are, of all the different option spreads, the butterfly will make the largest return on capital of any type of option spread strategy you'll find. So that's kind of an illustration there. Now let's take a look at a wide wing butterfly. Now, why a wider wing? So first off, they can be structured. Again, these are defined risk trades. The debit cost is the max risk. Fantastic for hedging. We can leg in and out. These are really great. I like to use these for kind of targeted directional, what we call swing trades that could last a day to a week or 2 weeks. They're great for what we call pinning. So we're looking at maybe going into an expiration on a Friday. It could be a weekly or a monthly, and we think that there's a good chance that it could go out at a certain strike at expiration. Then we can trade, and we can set up a butterfly for what we call a pinning trade at that strike. So really great for that. They're great for when we have a higher volatility market, because we're selling time and volatility when we do the butterflies. So high volatility, that's actually a benefit. Used for trading, again, volatile high price stocks. You'll see an example here of Amazon. So if you've ever wanted to be trading Amazon or Tesla or Google or something, and you just don't have enough capital, this is a way for you to do it. The trade duration on these is anywhere from, you can set up for a 1-day trade to about maximum I like to look at going out would be maybe 2 weeks, because we want to take advantage of that accelerated time decay that we get from using this strategy. It's a positive theta, so there's no time decay. That's the other great thing. If you're in a long trade, if you're long calls or puts, and if the trade doesn't go the direction you need it to, you're losing every day on time. So that's the time decay. This will always give you a positive theta, so there's never going to be any time decay issue. These can give you returns of 2 to 1 or 10 to 1 or higher, and I'll show you some examples of that. Now, here's a really great example to show you how you can trade a really high price, volatile, kind of big mover stock and keep your risk really under control. So here's an example on Amazon. So this trade will show you a couple of different really great benefits. So did this set up with $1,000 wide spread. Okay, so the target here, again, we were targeting 1830 right there. So Amazon had been churning right here at this 200-day moving average, and then we were looking for a potential move to 1830. Now, if you had, say, you went long the stock here where it was trading at 1,782, you would have to put up, if you bought 100 shares to make this equivalent to one option contract, you'd be putting out $178,200 to buy Amazon right here. Now, if it did hit your target at 1830, here's what would happen. So let's say we're having a target price of 1830, and you just went out and bought the shares. So you bought 100 shares and you paid $1,782. So that's basically $178,200. Now you hit your target at 1830, so you made $48 per share, but that's only 2.69% return on your capital that you put up at risk, and that's a huge amount of risk, in my opinion. Now, the other way you could have done this, and this is the trade setup example here to show you, is that you could, in this example, we did a butterfly. So we bought the 1820 call. We were targeting 1830, so that's our target price. So that's going to be the body of the spread is the target right here. So we bought the 1820 call long, sold the 1830 is our target, and then we sold the 1830 again, bought the 1840. So we just did a butterfly with a $10 wide spread, which is $1,000. So $10 times 100, That'd be 1,000. Now look at the cost of the trade, the risk. The cost of this trade was $80, 80 cents. That's the maximum risk you have on the trade. So if it collapsed and went straight down, you were looking directionally for an upside move. That's the most you could make, or most you would lose. And typically we'll always do an adjustment or so to not even lose that. So there are other things we can do, but that's the max risk going into the trade. Now, if you were to hit exactly at expiration that 1830 target, this would be a potential for $920 per butterfly spread profit. So if you did one spread, you theoretically might make $920 on your risk of 80. That's 1,150% return. Or the other way to look at it, you risk $1 to make potentially $11.50. Again, you're never going to make that exactly, but just think of it, if you made $100 or $500 on that risk, that's still a huge return. But it gets better because there are other benefits than just this. So one benefit is you can trade a high price stock for, $80 versus $178,000. Okay, your potential return is like 1,000 times more than you would make here. You potentially theoretically could make over 1,000% return. And the other benefit is that just based on time decay, I'll show you how that works. This trade setup was at $150 profit in the morning, and then it was up to over 600 in the afternoon, just that one day. And that's the other benefit, is that time decay that's working for you into expiration. So it's got so many great benefits. So here's the trade example going through it. So here is going out at the expiration on the 6th, and this is in the morning, so about 9:30 a.m. or 10 Central. So it was trading here, when it was set up, we were targeting that 1830. So it was actually went over the target price, and it was trading at 1836. So right here, so pretty flat, but all that area in there is still potential profit if it was to come back into this area here, this zone. But at that price right there in the morning, this was up $150 per spread. All right. So you can see it went from 80 cents or $80 to 230. That was in the morning, about AM 9:30 or so AM. All right. So that was up 150 per spread on your risk of 80. Still a pretty good return, 187% return. We'll take that all day long. But here's the beauty here. See the theta? It's got a positive theta still for the rest of the day of $80 that you're potentially could still make, depending on where it goes out in the afternoon. So here it was in the morning, 1836, and it was up 150, 187% return. And here it is the same day, but in the afternoon towards the end of the day for expiration. So look how this jumped, and it's all based on the time decay being sucked out and anything left on the volatility. So it went from, in the afternoon, it went from 80 cents to now it was up to $6.95. So $80 or 695. All right, so that was a profit then in the afternoon, the same day, of $614 per spread on your risk of 80. That's a 769% return. All right, so if you look at the first one, it made 150 in the morning, but now it was up almost 4 times more in the afternoon, and the return is the same, so huge. So risking $1 to make $7.69. So there are just so many great benefits and ways to take advantage and get some great trade setups by using these types of spreads. So a lot of great benefits that you can gain once you understand how they work. Now, here's another way that we like to use the butterflies is for short trades. So, if you've been trading this market and you try to short it, it's really hard to short because a lot of times the market might go down one day or could go down in the morning, then in the afternoon it's back up, or it goes down one day, the next day it goes back up. So it's been very hard to short the market. So what we've done is use the butterfly to short the market in order to keep our risk super low in case the shorts don't work. So here's an example of a put butterfly using SPY, all right, and the spread width here is $500. So again, it's structured low defined risk. We know exactly what it is. Great for high volatility markets. Trade duration, we can structure it 1 day, 2 weeks, no time decay, 10x to 10 times or higher return on your risk. So this trade setup we did using a put butterfly, all right? So we could have legged into this as well, and I'll show you an example here in a minute of legging into a spread and then converting it to a free trade by doing this same structure. So it was trading right here, at 392, and we're looking for a move here again, targeting our fib levels right in here at 390, and it blew a little bit past it. So what we did here was a put butterfly. All right, so we were targeting at 385 right here was our target, 385, actually right here. So we made it wider down. Our target was down to 385, but I look at it to see if we have profit even at any point in it. And that's what we can do with our analytics. We can always see what the profit would be at any point. So structure this for a potential move to 385 just to make it wide. All right, so wide wing butterfly. So we bought the 390 put, sold the 385. So you can see $5 wide spread. Then we sold the 385, 380. That would be like a bull put credit spread. All right, so what's the spread width there, everybody? So you can see 390, put debit spread 385, so $5. And then here's your bull put credit spread side, 385, 380. All right, so $5 spread width, 500 minus the cost. Look at the trade. So that's why the butterfly is a great one for a kind of a trade setup for short, because we can keep our risk super low. So if this went straight up, it never went towards our target, well, the worst case scenario, we'd lose 50 bucks. All right, so potential here, theoretically though, if it hit the body and went into expiration at 385, which we know it's not going to do it, but you can see the risk reward though, this would be a 900% return. But it went out 2 days later and we had an $86 per spread profit on $50 of risk. So big return still. That's kind of more like what we were thinking would happen. We were hoping it would be better, but that's still, when you look at your risk reward, 50 bucks risk and you reward of 86, 172% return. So again, that's the dynamics of these spreads, how they work, and take advantage of time decay and volatility decay. All right, so here it is going out. Now, for the perfect trade, it would have been going out right here at the expiration of the last couple of minutes of the day. That would have been your max profit. But again, we weren't expecting it to happen. We just wanted to have a wide enough profit zone to make a short and have still a high probability to make money. And so this went from 50 cents or 50 bucks to 136. So boom, just close it out here, take the money and run. And that was an $86 per profit or per spread profit, again, on that risk of 50. So there's the 172% return in 2 days. So it was taking advantage of time, volatility collapse, and it gives you a high return. So that's what we're taking advantage of. Now remember, when you sell, when you sell a credit spread where you're selling time and volatility, or butterfly that has that component, we're looking at expiration day 0, time goes to 0, and volatility goes to 0, and that's a big part of the profit that you can achieve from doing butterflies or long condors, to take advantage of that sell side spread component. And see here the positive theta, 29.75. Now here's another example. This is what we call option pinning or expiration trades, where you're looking, especially on monthly expiration. So when we have a monthly expiration, we can do certain kind of target analysis that we can do to give us an idea potentially where a stock might go out at expiration. So that means what strike it would maybe settle at on that last day. And so that's what we call pinning. And so then we can do an option trade strategy targeting that pinning potential price, and we can keep it really low risk in case we're wrong. But if we're right, we can make a huge return. So that's what we use a butterfly spread for. So here's an example on Apple. So we did this pinning trade with a $3 wide spread or $300. All right, so we were targeting here, Apple was trading at 131.20, and we were targeting this area right in here, this kind of 135 area right here. There was a lot of option activity, and we had a Fibonacci level here, so kind of look for a nice kind of a confluence of potential for a target. Okay, so we targeted 135. Okay, so we did this trade setup targeting 135. Right, so what we did was, again, target 135. So the call strike target was 135. So we did our body of the trade there, the short side of the trade right here. If I can get the pin here, I'll circle it. All right, so target 135. So long the 132, 135, that would be a call debit spread, then sold the 135, 138. Now you can leg into this or just do it as one spread, and you can do the same getting out. But you can see here, if we were targeting 135, we want to keep our risk low in case we're wrong. So in this case, you can see 50 bucks of risk. And we can even do, sometimes we'll do, typically on these types of trades, we can do it for a lot of times maybe $30 to 50 is kind of what I look for as the cutoff point. So you can, $30 is usually something you can do as well. But this was $50, so that's the max we could lose if we did nothing else. Now, at expiration, the 16th, it was trading at 134.09, so not quite perfect at 135, but still this was a big enough profit zone that it was trading right here. So this trade went out at 134.09, and so at expiration, it went from 50 to 208. So here's your potential, your profit was $158 per spread on that risk of 50 per spread. So you can see that the max potential would be, you can make 250, but this made 158 on your risk of 50. So there's a 316% return. All right. So that's the fun of it as well. If you get it right on that target that you have, you can make a huge return on your risk. Now, the next one, I'll show you what a long condor looks like and how this is used. So the long condor is a real favorite because we can widen out that zone. So I love to use these for legging into. Here's the structure, and we can do this with puts or calls. So we can leg into it, or we can do it as just one spread. Now, the thing that makes it great is that, we have a sell side component to it. So we're getting positive theta from that and also reducing and lowering our risk, but we can have a bigger profit zone. We can do this as one spread, or we can leg into it as well, like I said. So it's a defined risk trade, great for hedging, great for directional swing trades, gives you a wider profit zone than the butterfly, great for trading high volatility markets because we can get our risk really, defined and low, and we're selling time, so we get a benefit from that. Trade duration, it could be 1 day to out to 3 weeks, no time decay, so it's positive theta trade, and typically you'll get returns of 2x to 4x, something like that. So these are great, again, like I said, for legging. So this trade though we did on Roku, and this was set up just as a long call condor, not legging into it. So I like to look and use these when there's an area of potential. We think that area of big resistance, markets are pretty volatile. Roku had been one that had been a high flyer, and then you can see it just got crushed to the downside. So I wanted to keep the risk really low in case it started to fall back over. So we went long right here, and so this was based on a long trade, based on our trading model, based on momentum. So we had momentum was up cycle 1 and 2, so that gave us a long trade and a moving average cross that we used. So we went long here. It was trading right there, and I'll show you what it looked like with the actual chart. So we went long there, but we wanted to keep our risk super low. So we did this as a long call condor right out of the gate. So I'll pull this up and you'll see what that looked like. So we were trading right here on the 20th, and this was a trade setup. I've got alert service, and I send out these types of trades to the members of the service. So basically, I was looking at this, and big sell-off came down. We track momentum to give us direction. So you can see the momentum started to shift, and this was on our watch list. And so cycle 1 goes positive, and I want confirmation here. That's kind of the simplicity of it, and that would be our long trigger. So we're coming in here. It's hitting off the 200-day moving average, but kind of, not too trustworthy of Roku since it didn't hit hard. So we want to keep it really low risk. And here we go. So now, boom, right there. See that? See that orange arrow, the yellow? So that was our our buy trigger. So we went long. You could have gone long the calls, you could have gone long the shares, but we wanted to keep the risk super low. So we did this as a long call condor in case it rolled over. So then it popped up into our zone here. We shorted this area. So let me show you the structure. And you see what happened here. Roku did pull back, but now it's kind of flat. So what we did was a long call condor. So we bought the 28 May 332.5 call, sold at 335 as part of the spread. That's called debit spread. And then the other side of the spread was the 28 May 352 short call and the 355 long call, so a bear call credit spread. So 2 legs, you could have legged in, but we did it all as one spread at one time right here. So the call debit spread side, the put spread, the total cost of this trade was $74 per one spread. So, 74, if you did 10, that'd be 740 max risk. But the potential profit here is the difference. So if it goes out between your short strikes here of the 2 spreads, that's your max profit. So that would be $176 per spread if it goes out in here at expiration, which would be a 238% return. And on the 28th, we set this up on the 20th. And on the 28th, that was actually the day of expiration. We took it off some at 349.77. So that was up $133 or 180% return. And then it actually did close inside the short strike. So it did actually make the maximum of that spread at expiration. So let's take a look here and see the theta positive. Look at the big theta, $42, $43. So that goes in your pocket if it was just to sit there. Now here it is at expiration. It actually did go out right inside the 2 spreads. So that was max profit at expiration. So what we do on these, you scale out, you take some profit to make sure, if it's real volatile, it could go back the other way or back up. And then you try to save some to see if you can hit the home run part of the trade. So this one, close out part here when it's trading 349.77 right there. You can see the purple line. So it's not your max profit because there's still time and volatility in there. So it's still a pretty good return on your risk, $133 on risk of 74. And then at the end of the day, boom. And you have to do nothing because the short credit spread expires worthless and you keep the full credit from that. And then the call debit spread expires max profit. So this went from, 74 to 250 was the max there. So you can see the profit profile here, risking 74, potential max profit 176. Now here's another great way to use the condor for hedging or the butterfly, but this one is an example for a condor hedge. Now, when you're hedging, it doesn't mean that you're hedging to reduce a potential loss, but you can also hedge to improve your trade. So always look to, if there's a chance to improve a trade, I'm always looking at that. So when you're trading, and especially when you're trading options, try to think of options or trading as maybe a game of poker or cards or gin rummy or chess or something. When you're playing these kind of games, you're always thinking about 2 or 3 steps or moves ahead, right? So if you need a certain card you're looking for that. So that's a step. So when you're trading options, you can kind of do the same thing. So when I'm trading an option trade and I'm always looking, can I improve this trade by, adjusting it, maybe adding a credit spread or et cetera. So I can also improve it from reducing my risk, which increases my potential return, but I also can improve it by lowering theta decay and make it even a higher positive theta type trade. So in this example, it's showing you how you can use a hedge to improve a trade, and in this case, turn it into a free trade. So here's a long condor that was done on SPY, and this is a SPY long put debit spread converted or adjusted to a long put condor. All right, so it started off as a put debit spread, a negative trade, and then we adjusted it to improve the trade and made it into a free trade. All right, so defined risk, directional swing trades, great wide profit zone, 1 to 3 weeks, no time decay, great potential return. So the trade was right here doing a put debit spread, so it's trading right about 275, and we're looking for a breakdown and a target down to this fib level here around 2 270. All right, so the trade setup one was starting this trade out with a long put debit spread. So if you look at the trade here, it's a great low risk trade to begin with. So long the 273 put, short the 270. All right, so $3 wide, $300. Now, the cost of the trade, 65 cents or $65. So very nice trade setup, low risk, potential for a big return. You can make 235, but it would have to settle here or below at expiration, which has been hard to do with shorts. If it did, this would be a 361% return, but it doesn't seem to ever happen. So what we found out is that, okay, if it gets down here, let's take some profit on part of the trade, and then let's see if we can adjust it to maybe a free trade and just sit with it and see if we can improve on it. So this one broke down on the 29th, and it was trading down here at about 271. So we were able to close out for $98 profit per spread, which is not bad return, 150, but instead of closing the whole trade, then adjusted, and the balance we turned into a put condor. So let's take a look how that was done. And it was done as a free trade. Okay, so this also gave us some positive data. All right, so the next step was, okay, when it flushed down to that, it was trading around 270, we sold a bull put credit spread. All right, so we sold the 268 put short and bought the 265 below it. So a bull put credit spread. All right, and that cost 65, no, that received a credit of $65. All right, so we had the put debit spread cost us 65, and then when it flushed down, we looked 2 steps ahead, we were planning ahead. We were able to sell that credit spread, bring in 65 credit. So now we offset our debit cost of 65, and we've got a free trade. All right, so here's what it ended up looking like, and then you can kick back and see what happens. So we started with the 273 long put, short put 270 at $65 debit. It flushed down. Instead of closing out the whole trade, or the first time down, we converted this to a bull put credit spread, brought in 65 credit. So now we have 0 risk, and we've got this big fat profit zone, which if it went out in there, that would be a $300 return, but on our risk of 0. So it's basically an infinite return if you look at it. But it was going out right here, but still a nice big profit from the profit zone here. So it was going out right there, up $164 per spread, at that time. And we did that on 0 risk. All right, so that's the kind of the beauty of it. So now you had trade one. If you back into it, you'll see here trade one made $98 per spread. So not bad, 150% return. But trade two, by doing that adjustment, made 164 per spread on 0 risk. So, you can see the improvement that was done there by doing those two like that. Okay, so just, a lot of different things that you can do. Now, if you'd like to learn more about, how you can master these, really high reward, low risk trade setups that can work for you in any type of market environment, especially when we're in kind of now this market, there's always uncertainty in the market, but we're getting into that period of time now, it's summertime and all that, and we had a big run up. There's worries about inflation. There's worried, the opening of the markets. So the market currents are, crisscrossing. It's a very difficult time. So you want to keep your risk very controlled. And these are 2 great strategies to do that. But they also can give you great payouts. So I did a really fantastic options master's course just on the butterfly long condor. And if you'd like to pick it up here today with all the other bonuses of this for $97, please use this link, and it's yours forever. And I'll show you all the bonuses that you can get right here. So just click on that, powercycletrading.com/1EX. If you click on that, that'll pull up a payment link you can use, and then I'll show you everything you'll get from the bonuses as well. So this is a course I did. We did this course in February. It's a 7+ hour course, and if you'd like to check it out, $97, that's it. So you'll get that $97 back really fast, and you'll be probably one of the best things you've done is spending $97 here tonight. Now, with this $97, here's everything you're going to get. Not only the butterfly course, but some great bonuses. So you'll get this new course that I did here earlier. This was, I think this was a February, I have to look back now, but it turned out to be a 7+ hour course. So it was recorded, and then what we do is we break it down in modules. So the course is kind of outlined with modules, kind of like a chapter of a book. So you get this broken into modules of 30 minutes or less, so you can go back to different parts of the course that you might want to really review, and you go to that module, so it's pretty easy to find. So you get the recorded course, and then you get the full PowerPoint. My courses are really detailed with trade examples of how these different things work. Plus we go into a lot of the time pricing components and how that works. So it's a butterfly long condor course. If you go to my website, you'll have to pay $497. Now, you'll also get my options beginners course. So if you're this is a great package too, if you're just starting out in option trading. So for $97, you're going to get my options beginners course too, plus the butterfly course, plus to give you added support from this course once you do go through it. And if you want some additional support, you're going to get a trial membership to my trading club where we have a virtual trading room open every day, and our Q&A. So you can come in here, and this will be for the first 30 days. Now you can start this whenever you want. You don't have to start it today. So if you wanted to say start the trading club next week or a month from now, just send us an email, we'll start it for you. But I wanted to give you this for additional support. If you have any questions, or you come into our trading room, see what we're doing as far as trade setups. So you'll get that as another bonus. And then we'll do, in about probably 2 weeks, we'll send you a link for a live Q&A that you can join us, which will be live and recorded. So this will give you additional support. And then you're going to get my option trading tutorial. So basically another option course on the option Greeks and probabilities. You're going to get my option strategy manifesto. This is a guide on 15 other option strategies, and my Greek power tool guide. So you can print it out, put it on your desktop, and it just gives you what is delta, theta, gamma. Kind of gives you a good overview of those. If you're thinking, oh, I forgot what is gamma, what is delta, so you can put that out on your desktop. So the full, value here would be $1,182, but here it is for everybody here at $97. So hopefully you'll take advantage of it. It's a great course, one of my best courses that I do. I'll do this a couple times a year, and then you'll get the course, 7+ hour course, broken down again in modules. You'll get the full PowerPoint, very detailed, 456 pages of that, step-by-step, what I call my blueprint course on the butterfly long condor for income, hedging, profits, etc. So in the course, part 1 is really focusing in on the Greeks that make the butterfly long condor work, which are basically going to be tied to time decay or theta, how that works and impacts butterfly, how volatility works as far as the pricing component, how that works. So if you're just starting out, or if you're a more advanced option trader, it's a great review of the Greeks that are important to make these two types of trades work. And then very important to understand how option pricing works. So you're going to get all that in this course, in the first part of the course. So it'll really help you up that learning curve right away. And then I'll also in the course cover what we call Fibonacci price target mapping, using Fibonacci moving averages and standard deviation to set price targets. So when we're looking at price targets, especially for pinning trades, this is what we use. So this is also covered in the course. And then, the core basics that most traders miss, they don't understand what really makes these guys work. So, you'll understand all that in the course after you take it. And then we get into every type of variation of the butterfly. How, why, and when would you use a long or call or put butterfly, the wide wing butterfly, a broken wing butterfly, ratio butterfly, broken wing ratio butterfly, iron butterfly, vacation butterfly, long condor. So if you've ever seen Forrest Gump, every kind of shrimp. But in this course, I go through every different type of butterfly variation, so you understand, okay, I might want to use a broken wing for this situation, or a ratio for this situation. So how, why, and when to use the different variations. Okay, so, and then what are the best time frames to use? Should I go out a day, 2 days, 10 days? How do you get those setups, and which one would we look for to give us 10 to 1 or higher? How to take advantage of option volatility collapse and theta decay, use the butterfly condor, how to use these for monthly option expiration, which we call the pinning trade. So this is kind of a new additional stream of income you could add to your trading. So every month we have an expiration, and these are what we do a lot of times for these monthly expirations. That's what we call option pinning. So we do in this course, we'll take you through the price target analysis that you do to establish a potential target, and then how to set up the butterfly to take advantage of that potential for a pin for that expiration. And then go into the long condor, the major trading advantages of using the condor, long condor, either call or puts, when to use those to give you a return of 100, 200, 300%. So low capital at risk, positive theta, big wide profit zones. And so when and how and why would you select and use the long condor? So that course covers that. So which strategy to use in what situation kind of thing. And so cover in depth on the long condor. And then part 3 is a big chapter. We really focus on hedging. All right, so we're going to get in a situation here sooner or later where you're going to be really happy that you know how to do quick hedging. All right, so this course will teach you and how to do that. So I have what I call the progression of hedging in the course. So it's a module to show you, all right, what if I had 100 shares or 200? How can I hedge that? How can I hedge a debit spread, a credit spread? So takes you through the progressions, and then how to use the butterfly and long condor for hedging a core position, how that's done, and then how to use the butterfly long condor to do a hedge on a, say, a vertical debit spread or credit spread. How many people here do credit spreads, and how many people that have done credit spreads have been burned by getting your short strike, penetrated, and so then you lose big. All right, so this will show you how to defend that, especially the credit spread. And then you get a step-by-step checklist when and how to put the butterfly condor on and off, execution trade management, and then you get a resource chapter which takes you through exchange traded funds to use, what is assignment risk, expiration risk, auto exercise, and assignment. So another great chapter there for you. If you don't understand what that is, expiration risk or assignment risk, this will explain it all to you. And then there's a trading library. So I think that, I learn visually. So I like to look at trades, break it down. It helps me to learn why they work and how they work. So you'll get a nice trading library of these types of trades as well. So that's kind of an overview there. So here's a little feedback from a couple of my members. Said, here's Alicia, said, I've never seen anyone explain options like this. Excellent. This is exactly what I've been looking for. Very informative. No one has anything like this. Wish I'd found this sooner, but glad I found you now. Thanks again for your time. This is from Pam that had that trouble with those credit spreads. Said, excellent class, Larry, as usual. Under promise, over deliver. Wish I'd known how to do this hedging before I lost so much money doing those credit spreads. So special bonus 1, you're going to get my option trading for beginners. So this is, if you're just starting out, it's a really good comprehensive course on the benefits of options versus stocks, puts versus calls, option expiration, how that works, and takes you through a couple of different kind of beginner option strategies like covered call, and also takes you through the what we call a protected put collar on a trade like covered call. So it's a really great beginner's course, and you'll get that videos and PowerPoint on that. So bonus there. You'll get a trial membership to my trading club for 30 days. And if you would like to stay on, then it's $97 a month, or you do an annual membership. And this, you can start whenever you want. If you want to start it a week, 2 weeks, whatever, just send us an email. We'll start it when you want. And this is a really nice compliment from Richard. I got this a few weeks back. He said, today I got back to work full time at Mandalay Bay Convention here in Vegas. They shut us down in April 16, 2020. Larry and his trading services helped me survive this last year. So I was really very, very pleased to hear that. That was fantastic. And he said, Larry, I wanted to thank you. I am glad I found your service. I'm learning so much. Thanks, Richard. This is from another member, said, this from Jay, said, Larry, just wanted to say my option knowledge has leaped exponentially since joining your trading room. And this is the thing I wanted to point out. He said, reading books is fine, but seeing the actual option trade setup makes a huge difference. Thanks, Jay. So you'll get my virtual trading room open every day in the morning, 9:30 to 10:30 a.m. Eastern. Okay, and then I come back Monday and then Wednesday for the close. But every day during the week, I'm in there for the morning session for an hour. And that's where all the action is anyway. And then with the virtual trading room, with the Power Trading Club that you'll get as a bonus, you get that. Plus, you'll get my daily video newsletter that comes out every day after the close. So it gives you an overview of my, what's going on in the market from my perception, any trades that we're looking to set up or that we've done. So go through that in the video. And then these are archived. Then we do a weekly Q&A every Tuesday. So we did one today, was over an hour, usually hour to 90 minutes. And so this is a live Q&A, and then these are recorded. So you get those every week. Come in, ask whatever questions you have, any help you need. But in the trading room, you've got that access. So if you need any trade help on anything that you have on, come in there, ask questions. Now the Q&As are all archived. Then you can go back and review them. You got a trader's educational ball, a lot of great free educational material on options, videos, all kinds of great stuff. And also a 60% discounts on all courses and trading software. This is another one that I was really happy about from Sam. He said, this I just got recently. He said, Larry, I was very scared to trade options. I never made a penny with options, but thank you for giving me the confidence in trading options. Thanks a ton, Sam. So, that's a really great benefit. So bonus one, then you get that, but then you also get a follow-up Q&A. So for more support, and then you're going to get that. We'll do that a week or two out. You'll get a link for it. And so you'll come into the Q&A and ask questions there, and it'll also be recorded. Plus you're going to get the trading room for 30 days, the trading club. So that'll give you additional support to help you be successful. And then you'll get my option trading tutorial. So 60-page option guide with videos that covers more just all into the Greeks, delta, gamma, theta, et cetera, implied volatility, how option pricing works, what we call market maker secret probabilities, standard deviation, option delta, and trade probability. So another option course. So you're going to get covered. This will cover pretty much all your option needs. And then you get my top 15 other option strategies to tell you about. So it tells you trade construction when to use, like what's a back ratio spread, what's a diagonal spread, what's a short straddle, long straddle. So another really good benefit here, educational material for you as a bonus in the Greek Power Tool Guide here. So it's a lot of great stuff, and here's the link. And I really encourage everybody. Hopefully you'll sign up. If you need, if you want to ask a question, say you wanted to start your trial membership at a different time, just send us the email support@powercycletrading.com. Okay, so send us an email there if you have any, if you want to say, hey, I'd like to start my trial membership at a certain date, just do that. We'll start your time whenever you want. Now, if you decide to, hopefully you'll stay on as a trading club member, then you can do this for $97 a month. It'll just be at $97. Or if you want to do, a really nice discounted annual membership, it's $488. So you can do that as well. Okay, hopefully that gets you there. And that's it. So any specific questions here? Be happy to answer any other questions that you might have. Yeah, here's the link again, powercycletrading.com/1x. Now, yeah, here if you go to my, let me show you the website so you can see everything that you also have access to. As a member, then you get discounts of 60% off on all my other courses and trading software. So if you just go to powercycletrading.com here, Powercycle Trading, you can always then find out what we've got coming up. So if you click here, upcoming live events. So for this Saturday, I'll be doing a free course webinar, just a free webinar. So come join us on how to find better trades using the different trading patterns that I use, the tools and strategies. So things like that, we always have good trading things going on, so you'll get that. Now, as a club member, you can go to courses and you can then hit trading courses, boot camps, coaching. If you hit trading courses here, then you can get anything on my website at a discount of 60% off. So you can see here, you can pairs trading, selling options for profits, for income and profits, did that. This we just completed this course, so this is wrong. This needs to be changed. But you can buy anything here at the price that we have, but with your members discount, you'll get this at a 60% discount. So here $497, you get that at 60% off. So you know that course. Then you'll see here's the butterfly course that you're getting here for 97. Here's my calendar diagonal course, earnings course, butterfly. So did this in February. So if you look here, this course is for sale at $497. So you're even getting a better price than even the members price. Options Masters course, this one I just completed. Fantastic course here. So if you want to pick up on this one, you can get that for 60% off. But here today, man, you're going to get everything plus all his bonuses. And then any trading indicators, I've got a slew of indicators that I've developed. You can get any of these indicators at a discount of 60 off. So we'll cover everything for you and help you out in your trading needs, especially when it comes to options. So that's kind of my specialty, directional trading with options. And so then you'll get a login. So you can click here, come into the trading room. You'll get a login for all that good stuff and come check us out. You'll be glad you did. I'm not sure. I think Expo was going to record this, so I believe there probably will be. Any other questions? All right. Well, thanks again for spending some time with me. Here's the link one more time. So just powercycletrading.com/1EX, or just click on that link and you can credit card or PayPal. And if you look at 97, boom. Can't buy much anymore for 97. But I'm happy that you do it. I really, try to provide great educational stuff, especially kind of focused on options, and try to give you great value so you can, learn and feel comfortable about, the money you spend and get great value from it. All right. Well, thank you so much, Jim. Everybody have a great rest of your evening, and good luck trading, and make sure to check us out, powercycletrading.com. And if you join us, then hopefully I'll see you in the room. Thanks again, everybody.